Len, describe the risk Premia ETF fund range.
So within the equity asset class, there are various risk premia, or risks that if you take exposure to those risks, they tend to reward you over a long period of time. So the best way to describe that or explain that is equities will tend to outperform bonds over a long period of time, but that doesn't mean that equities outperform bonds over all time periods. Over short periods of time, bonds may outperform equities as well. Within equities, we find a very similar pattern developing. There are various risks that will reward you over the long term, not necessarily all the time and over all time periods. But if you're exposed to these risks on their own, you'll typically get an excess return over what the market is giving at the time. So within equities, we've identified 3 risks that reward investors for taking those risks over long periods of time. The first one is value. So typically shares that trade at a discount to their fair value, at a discount to their historical value, rally and will reward investors for taking risk of investing in undervalued stocks. The second one is momentum. Now, momentum is an interesting one because it's more of a behavioral economic phenomenon where people don't necessarily respond very fast to new information in the market. And what you tend to find is that as prices increase, more and more investors become comfortable with investing in those shares, and you tend to have an exaggerated effect from a price appreciation perspective. So shares that have performed well in recent times will tend to perform well going into the future. And then the last risk that we see is low volatility. And that essentially is shares that don't have a very big dispersion around their mean tend to perform better than high risk stocks. And that's a little bit of a difficult one to explain to retail investors, because retail investors typically associate high risk with high return. But what the research suggests is that within equities as an asset class, being exposed to low risk shares rewards you relative to being exposed to high risk shares. The parameters that we have used to select the underlying stocks is not necessarily different from what is currently used in the market, because typically you can back test each of the risk premia and see which parameters are the best ones to use. What we have done, and this is the first in South Africa, is when we weight our portfolios, we specifically target risk management as an outcome. And what we mean by risk management is we try to prevent an overexposure to a small number of stocks. So as an example, if you're exposed to the top 40 ETF or a top 40 basket of shares, 65% of your market cap is concentrated in 10 stocks. Now that adds a lot of risk to your investment portfolio. So what we have done is we weight the portfolio so that you get an equal contribution to risk from each of the stocks in the portfolio. And our research suggests that actually benefits you over time. So we will hold very similar stocks to what our competitor products will hold, but just the weighting methodology will typically lower the volatility of the fund, which often has a very beneficial impact on the performance. And on a risk-adjusted basis, investors are in a much better position because of the risk management that we perform. I think the temptation for a retail investor is to look at these risk premia, have a look at their performance over time, and invest all of their money into the one that performs the best. The problem with that is that, as I mentioned earlier, these risk premia tend to perform at very different times in the cycle. And because of that, you want to have exposure to as many risk premiums as you possibly can at any point in time. A very simple strategy would just be to equally weight each of the risk premia. So take a third exposure to momentum, a third exposure to low volatility, and a third exposure to value, and construct a portfolio on that basis. And our research suggests that you will get an excess return over the market over time just by doing that. Because these are exchange traded, typically whoever you buy them from will need to have some sort of a channel to trade on exchange. Now that can be a private client stockbroker, most of whom have online facilities now. And if you're an ABSA client, it's very easy to open an ABSA account with the ABSA stockbrokers and trade that online. There are also some LISP platforms or linked investment service providers who provide access to exchange traded funds. The nice thing about exchange traded funds is that you can hold them in tax-free savings accounts as well. So it's possible to buy these and not be taxed on the capital gains and the distributions that you'll receive from holding them.
Thank you, Len, for joining us and sharing your knowledge on the ETFs.
Thanks, Andrew.
And thank you for tuning into Black Onyx. For more details, please visit our website.